Welcome back to Marginal Thoughts, everyone. Okay, let's just say it. Times feel, well, a bit uncertain, don't they? You see rising prices, the markets seem kind of jumpy, and honestly, the headlines alone can make anyone feel nervous about their money. But here's a thought. What if all this uncertainty wasn't just something to, grit your teeth and get through? What if it's actually an opportunity?
It sounds counterintuitive, maybe, but yeah. Historically, these periods of economic turbulence, these shaky times, they've often been the exact moments when some pretty significant wealth was built.
Right.
For people who are prepared, who kind of understand what's going on, these times can genuinely be a chance to turn those challenges into a financial advantage.
Exactly. And that's really what we want to explore today. This is aimed squarely at you if you're maybe newer to navigating these kinds of economic shifts and you want to get a handle on how to approach them.
Yeah, we've looked at different successful approaches throughout history, mixed with current thinking on how you can actually build wealth, even when things feel, well, unstable.
Our goal here is just to unpack the key ideas, pull out the most important insights, and help you figure out what really matters when the economic waters get a bit choppy.
So let's get into it.
Okay, so the first big idea, the core concept that seems to jump out, is shifting how you view uncertainty itself. It's not just a threat.
No, it's potentially an opportunity.
Yeah.
Economic downturns, uncertainty. Yeah, they're scary in the moment, no doubt. But history shows they've often been like really fertile ground for creating wealth.
You see it again and again. You mentioned historical figures like Rockefeller, right? Making huge moves in tough times.
Absolutely. And even more recently, think about someone like Warren Buffett during the 2008 financial crisis. His actions then are pretty instructive.
And the key is why this happens, isn't it?
That's the fascinating part. Fear. Fear grips people. It causes widespread selling, panic selling sometimes, and that drives asset prices way down.
Suddenly things are on sale.
Exactly. It's like a massive discount season for investors who are informed, who could look past the immediate fear and see the underlying value.
Almost like a Black Friday sale, but, for stocks or other investments, and potentially a much bigger.
You mentioned Buffett in 2008. He famously put $5 billion into Goldman Sachs. Looked incredibly risky then, right? Middle of the storm.
Yeah, terrifying.
But he saw the fundamental strength, the future beyond the crisis. And, well, that investment paid off handsomely. Billions more.
We saw it with other companies, too, like Starbucks. Their shares plummeted, but investors who knew the business, who believed in it long term,
They saw the chance to buy low. Which brings us to a really, really crucial point, especially if you're just starting out.
Okay.
All this talk about buying opportunities, buying the dip, it's kind of useless unless you've built the foundation that lets you actually buy when everyone else is selling in fear.
Right. You can't take advantage of the sale if your wallet's empty or you're worried about next month's rent.
Precisely. That solid financial foundation, it's not just about feeling secure. It's your shield. It protects you from being forced to sell your own investments at the worst possible time, and it's the source of capital for that discount season.
Okay, so before the exciting buy low stuff, we need the groundwork. Where do we start building that foundation?
Number one, non-negotiable.
Yeah.
The emergency fund.
The safety net always comes first.
Always. Having cash tucked away enough to cover, say, 3 to 6 months of your essential living expenses is absolutely vital.
Because life happens, right? Job loss, medical bill.
Exactly. And if something like that hits during a downturn, the last thing you want is to be forced to sell your investments when their prices are crushed just to cover costs. That fund protects you from that terrible scenario.
Makes sense. And then budgeting. Not the most thrilling topic, maybe, but fundamental.
Oh, absolutely fundamental. You need to know where your money is going. Analyzing your spending lets you see where you can potentially cut back, free up cash.
Like using those frameworks, the 50-30-20 rule, perhaps. Needs, wants, savings.
Yeah, things like that can provide a simple structure. 50% on needs, 30% on wants, 20% towards savings or paying down debt.
Yeah.
The main goal, really, is just to consistently live below your means. Create that gap between income and spending.
That gap is where the magic happens over time. Living below your means. And speaking of freeing up money, debt, especially high-interest debt.
Critical. Credit cards, payday loans. That stuff is like an anchor dragging you down, especially when interest rates are higher. Paying that off needs to be a huge priority.
Trying to invest while carrying high-interest debt is like trying to fill a leaky bucket, right?
Perfect analogy. You're undermining your own efforts.
Okay, so foundation. Emergency fund secure, budget clear, high-interest debt tackled. Once that's solid, then we talk about getting money ready specifically for these opportunities.
Yes, this is about building an additional cash reserve. separate from your emergency fund.
Ah, okay. This is the dry powder people talk about.
Exactly that. Think of it as capital you have ready to deploy. It gives you flexibility. When potential buying opportunities pop up during a downturn, you can actually act.
While others might be stuck, maybe their investments are down or they just don't have spare cash.
Right. Look at Buffett again. 2011, the Eurozone crisis was unfolding. He had cash ready, invested in Bank of America, got really favorable terms because, well, he had the cash when few others did or were willing to step up. That's the power of dry powder.
Okay, foundation built, investment cash set aside. Now, understanding the market itself, and maybe more importantly, understanding our own psychology, our mindset. Because market downturns aren't weird, rare events.
Not at all. They are a normal, recurring part of how markets work. Understanding this is huge for managing your emotions when things get rocky.
So these different types of declines, corrections, bear markets.
Yeah, good to know the terms. A correction, that's roughly a 10% drop or more from a recent peak. Historically, these happen like almost every year or two on average. They're pretty common.
Okay, so a 10% drop shouldn't necessarily cause panic.
Ideally, no. Then you have a bear market, which is generally defined as a 20% or more drop. These happen less often, maybe every 4 or 5 years on average historically, and they tend to last longer, several months usually.
And it collapses.
Those are the really sharp, fast drops, like 7% or more, quite quickly.
Right.
Much less common, thankfully.
Right.
But the point is, recognizing the drops, even significant ones like 20%, are actually quite normal cyclical events you should expect over an investing lifetime.
That changes everything, doesn't it? It's not some black swan event every time. It's a feature of the system.
Exactly. It reframes it completely. It's not if a downturn happens, it's when. And being ready for when is the game changer.
That helps manage the fear. The material also talks about market crash phases to understand the psychology.
Yeah, it breaks it down, which can be helpful.
Yeah.
First phase, euphoria. This is often the peak, driven by maybe irrational excitement. This time it's different thinking.
Warning signs might be things like crazy consumer spending, credit being super easy to get, maybe speculative bubbles in certain assets.
Precisely.
Yeah.
Like the housing boom before 2008, or you can even point to the NFT craze more recently. Everyone feels like an investing genius.
Okay, so during euphoria, when everything feels great, that's actually the time to be cautious.
That's the time to prepare, evaluate your risk. Maybe reduce leverage. Borrowing money to invest can amplify gains, but it crushes you in a downturn.
And crucially, this is when you should be seriously saving that extra cash, right? Building the dry powder.
Yes. When everyone else is getting greedy and complacent, that's often a signal to be a bit more conservative, save more. Diversification is also key here.
Don't have all your eggs in one overheated basket.
Right. Think tortoise and hare. Slow, steady, prepared often wins over chasing those crazy, potentially unsustainable returns during the hype phase.
Then comes the reckoning, the crash itself, reality bites, panic starts to spread.
And this is the big test, your emotional resolve. Everything inside you might be screaming, sell, get out.
This is where the biggest mistakes happen.
Often, yes. The absolute key takeaway here is, do not panic sell good investments just because the price is falling. This is why understanding why you invested in something in the first place is so vital.
Knowing the underlying strength of the company or asset.
Exactly. If you understand the business, its fundamentals, its long-term prospects, you're much better equipped mentally to hold on when the price is dropping purely because of market fear, not because the business itself suddenly became terrible overnight.
Like that Peter Lynch example, holding Kaiser Industries because he knew they had no debt, even while the stock price tanked temporarily.
Perfect example. Knowing the why gives you conviction. The reckoning phase is where you prove you're actually a long-term investor, not just someone who says they are when times are good.
And if you've prepared with cash, this is potentially a time to use it, to buy the dip.
Potentially, yes. But trying to perfectly time the absolute bottom is, well, pretty much impossible, and usually a fool's errand.
So how do you approach buying when things are falling?
A great strategy is dollar cost averaging. You invest a fixed amount of money at regular intervals, say, every month, regardless of the price.
So when prices are low, your fixed amount automatically buys more shares.
Exactly. And when prices are high, it buys fewer. It smooths out your purchase price over time and takes the emotion and guesswork out of trying to time the market.
Takes the pressure off finding that perfect moment. And having cash ready means you can act, like those dollar stores in 2008 buying up cheap inventory from failing businesses.
Cash becomes king in those moments. Opportunities appear for those who have it.
Okay, then after the reckoning comes the Phoenix phase.
The recovery. The market starts to rebuild, confidence slowly returns, and eventually, historically, it tends to exceed its previous highs.
It might take time, though.
Oh yeah, it can take time. Recovery isn't always fast. After 2008, it took several years for things to feel truly normal again for many. But the key insight is that a bull market, a rising market, almost always follows a bear market eventually.
So those who held on, or especially those who were able to buy during the reckoning,
They benefit the most as the phoenix rises from the ashes, so to speak. The seeds of future gains are often sown during the deepest pessimism.
okay, great framework. Understand the cycles, prepare mentally and financially, recognize the phases. Now, let's talk actual investing strategies during uncertainty. Passive versus active.
Right, two main paths outlined. Passive investing is essentially buying the whole market, or large chunks of it, rather than trying to pick individual winners.
So investing in a broad index fund, like one that tracks the S&P 500 or the total stock market.
Exactly. You're buying a tiny piece of hundreds or even thousands of companies all at once.
The big advantage, especially for beginners, seems to be instant diversification.
It really is. If one company in the index struggles, it's balanced out by all the others. It dramatically reduces the risk associated with picking the wrong individual stock.
And the strategy itself is pretty simple.
Incredibly simple, often summarized as always be buying, or ABB. You just consistently invest a set amount of money, regularly, maybe weekly, maybe monthly, no matter what.
Regardless of market ups and downs, political news, scary headlines.
Always means always. You stick to the plan.
And the win with this approach.
It's really about leveraging long-term history. Despite all the downturns over the past century, broad markets like the S&P 500 have shown a strong tendency to recover and deliver significant growth over long periods, averaging around 10% per year historically, before inflation.
It requires less work, less stress maybe, and avoids the risk of picking duds. There are simple ways to do this, like through ETFs.
Yeah, exchange-traded funds like VTI, Total U.S. Stock Market, SPY, or VOO, S&P 500, make it really easy and low cost to implement a passive strategy.
Okay, so that's passive. What about active investing?
Active investing is different. It requires more work, definitely more research, and it carries higher risk. But the potential payoff, if you get it right, could be higher returns than the overall market.
You're trying to find those unique opportunities the broad market might be overlooking.
Exactly. And a key part of active investing, especially in changing times, is identifying what are called market shifts.
Okay, what does that mean?
It means understanding where the money, where the investment is likely going in the future because of big economic changes, technological advancements, or new trends, not just looking at where it has been historically.
Like the Sears example, they missed the shift to the internet.
Classic example, they didn't adapt, and, well, we know what happened.
Yeah.
So active investors today might be looking at shifts like,
What kind of shifts are being talked about now?
well, things like the huge growth in artificial intelligence, right? That's creating massive demand for things like data centers, which in turn need a lot more energy. That's a potential shift.
Okay.
Or government investment in areas like space exploration that could benefit specific private companies involved. Or maybe tariffs aimed at bringing manufacturing back domestically that could boost demand for logistics, transportation, maybe railroads specifically.
Other examples mentioned were things like government needing to upgrade old tech infrastructure or potential deregulation in finance.
Right? These are all potential large-scale shifts that could create winners and losers. The active investor tries to identify these shifts early.
But identifying the shift is only the first step, right? You still have to pick the right companies within that shift.
Absolutely crucial point. Just because a sector is growing doesn't mean every company in it will succeed. Far from it. So the active investor has to do the hard work. Dig into specific companies.
Looking at their financials, their management team, their innovation.
Yeah. Reading reports, listening to earnings calls, really trying to understand the business and whether it's well-positioned to capitalize on that shift better than its competitors.
That definitely sounds like a lot more effort and more risk if you pick wrong.
It is. Significantly more effort, more research, higher risk. It's not for everyone, and honestly, the passive approach is perfectly valid, often recommended, especially when starting. Some people blend both.
Makes sense. Okay, so let's pull it all together. Thinking about someone wanting to build wealth, especially through these uncertain times, what's the sort of winning mentality?
I think it boils down to this. Uncertainty absolutely creates opportunities. We've seen that. But capitalizing on them isn't luck. It requires preparedness.
And preparedness is twofold.
Exactly. You need to be emotionally prepared. Understand that investing is volatile. Prices go up, Prices go down. It can feel like a roller coaster. You have to learn to manage your fear and greed, separate emotions from financial decisions, especially when things look bleakest.
Stay calm when others panic.
Yes. And second, you need to be financially prepared. That means having the solid foundation we talked about, the emergency fund, manageable debt, and having that additional investment cash, that dry powder, ready to go.
So when the downturn hits, when prices are low,
You're not forced to sell, you're not paralyzed by fear, and you actually have the funds available to take advantage of those lower prices, buying good assets on sale, while others are running for the exits.
and doing that consistently allows you to potentially build wealth faster during volatile periods than just investing when everything feels safe and prices are high.
Precisely. What really comes through is that building wealth isn't necessarily about how much you earn, it's about what you do with what you have consistently over time, and especially how you act during these inevitable periods of uncertainty.
Understanding the game, staying prepared, acting rationally when others aren't, that's how you position yourself for long-term success.
Well put.
So, maybe a final thought for you, the listener, to chew on as we wrap up. Economic uncertainty is going to happen. It's inevitable, and yeah, it often feels uncomfortable. But what if? What if you started viewing it not as just some random roadblock or something to dread, but as a recurring event, a natural part of the economic cycle that is actually ripe with potential, but only for those who are prepared? What if making that mental shift is the most important step you can take in your financial thinking?
Definitely something to ponder.
Indeed.
Mm.
Well, thank you for joining us for this discussion on marginal thoughts.
Yeah, we really hope this gave you some useful ideas and maybe a clearer framework for navigating whatever the economy throws our way.
We'd love to hear from you. What stood out most to you about navigating uncertainty after listening to this? Let us know your thoughts in the comments below.
And hey, if you found this helpful, if you want to keep exploring complex topics and trying to make them understandable, please do subscribe to Marginal Thoughts. We'd love to have you back for more.
Until next time.